Now, stablecoins play a crucial role in the world of DeFi. We use stablecoins all the time, but the question is really, how do we really know which stablecoin is going to really stand the test of time? It's still relatively early, isn't it? And a lot of the strategies that we use in DeFi, I mean, some of them I've covered on the channel before, but some of them involve quite complex strategies involving numerous different applications, looping, and all sorts of different strategies. And as a result, you might want to kind of protect yourself against the downside of some of these strategies. Now, one thing that we've seen and one thing that really affected me over the last year was the big depeg that we saw with UST. Terra collapsed, of course. You know, if you scroll down my channel, you'll see loads of videos about UST and some of the complex strategies that we did with it. But sadly, obviously, it's all gone down to zero. And you know, is there really a way that you can protect yourself against that? Is there a way to protect yourself against the depegging of stablecoins? Well, there is now, and that's what we're going to talk about today. Let's get straight to it. Hello and welcome back to the channel. My name is Wajaha, and today we are talking about a really interesting protocol that's come out on Arbitrum. This one is called Y2K, and I thought we'll just kind of go through the documentation today and just kind of briefly talk about what it is, how it works, and I think later on, probably in one of the next videos, we'll kind of do a tutorial of how to actually set up your positions on Y2K. So without further ado, let's jump straight on to the documentation. And I thought we'll just kind of talk you through the products that they've got at the moment and kind of how it works really. So Y2K, this is how they describe themselves. Y2K Finance is a suite of structured products designed for exotic peg derivatives that will allow market participants the ability to robustly hedge or speculate on the risk of a particular pegged asset or basket of pegged assets, which is pretty interesting, deviating from their fair implied market value. So, you know, what does that really mean? Well, essentially, they offer different products for users to basically sell insurance or for users to buy insurance against the depegging of their assets. And at the moment, they've got 5 different stable coins at the moment. They've got Tether, USDC, DAI, Magic Internet Money, and Frax. And essentially you can sell insurance or buy insurance, and they've got these 2 vaults at the moment, which we'll talk about in a moment. These are the products at the moment. So they've got Earthquake, and this main product that they've got. So what actually is it? How does it work? So let's talk about the mechanics. So this is what I just talked about. Earthquake has these 2 vaults. You've got the Hedge vault and you've got the Risk vault. And essentially, a user can purchase insurance on a depeg event on any of our supported assets, which are the ones that I just talked about. When doing so, you mint an ERC1155 token, which represents your position within the vault. And we'll talk about this again when we go onto the platform as well. On the other side, users can sell insurance by depositing ETH in the Risk vault, and these users mint an ERC1155 token, again to represent your position. So in both the Hedge and the Risk vault, you deposit ETH, and that's essentially you purchasing or selling insurance. So if you want to purchase insurance, you deposit in the Hedge vault. You know, you want to protect yourself against any sort of depegging event. And if you don't think that the asset is going to depeg, you think it's going to hold its price pretty well, you can deposit your ETH in the Risk vault. So let's talk about this. How does it work exactly? So there's a deposit period. Now users can deposit into Y2K vaults during the deposit period of the epoch. After the deposits, funds are locked for the duration of the epoch. Now, each one is usually they've got 2 different types. They've got weeklies and monthlies. So for the weeklies, the first 2 days are kind of the deposit period, and then for the last 5 days, that's the kind of duration of the rest of the epoch, in which if you know a depegging event happens, and you know something will happen there. So during the first 2 days, nothing happens at all. It's only during the last 5 days, and the same thing for the monthly as well. So you can see here, it says here, note that the depeg protection is only initiated after the deposit period ends, which is those first 2 days. So let's talk about the risk deposit. So users who are seeking to get exposure to the depeg risk market would deposit in the Risk vault. So for those who, you know, don't think that it's going to happen, you want to kind of sell this insurance, you know, you can deposit your ETH in the Risk deposit. And these depositors collect some of the premiums from the Hedge vault deposit. So this is kind of PvP, you know. Hedges, they have to pay premiums for that insurance. The Risk deposit, they're risking their capital, but, you know, they are collecting those premiums. So the scenarios are essentially as follows. So if the vault does not depeg, the risk vault depositors receive their premiums from the hedge vault deposits. If it does depeg, the risk vault depositors receive their premiums as they were before, but they will transfer their principal to the hedge vault depositors. And likewise on the other side, users who want to seek a hedge against volatility in their pegged assets will deposit in the hedge vault. And when they do so, they have to pay a premium, and this premium gets transferred over to the risk vault depositors. However, in the case of a depeg, all of those risk vault depositors, all of their deposit gets transferred over to the hedge vault depositors. That is basically the principle of Earthquake and how it works. So they use some oracles, and here's the different price feeds that they use for the 5 different stable coins at the moment. And yeah, that's pretty much it. Now, the protocol does collect a fee. They collect 5% of the hedge vault deposits and 5% of the risk vault deposits when there is a depeg event. And there's no fee if the peg is maintained. So you can pretty much guarantee that as long as people are depositing, this protocol is making a profit. So here's a nice little picture at the moment. So consider the following example with Magic Internet Money. So if there's no depeg, this is what happens. So you've got the hedge depositors on one side, and you've got the risk depositors on the other side. So imagine you're on the street and you think that MIM is not going to depeg. So what are you going to do? Well, you're not going to hedge because you don't think it's going to happen. You're going to risk. You're going to sell that insurance to the hedgers, right? So what you're going to do is you're going to deposit some ETH, okay? And the kind of strike price is 0.99. So as long as if MIM goes below 0.99, it's depegged. As long as it stays above this value, you're all good. So you deposit your ETH, and at the beginning of the epoch, you receive your ERC1155 token that represents your position within this vault. Now, at the end of the epoch, because MIM has not lost any value, MIM's maintained its peg, the risk depositor, so you will receive the hedge deposits, less fees, and the initial ETH that you deposited in the risk. So you get your money back, plus you'll get the fees. You'll get the premiums that the hedge depositors have given you. And that's essentially how you make money. Now, if you're on the hedge side, you thought maybe, I thought MIM was looking a bit weak this week, and I thought there was a chance, or you wanted to protect yourself, you were on some crazy degen strategy and you wanted to protect yourself. Well, you would deposit some ETH that would, again, give you an ERC1155 token that would represent your position. And that hedge deposit will go to the treasury. 30% of the fees go to the Y2K token holders, which we'll talk about in a moment. But yeah, essentially, MIM didn't lose its peg, so what's going to happen? That premium is going to go to the risk depositors. And so yeah, the hedge depositor lost his money, but at least Magic Internet Money hasn't lost its peg. And so for this hedge depositor, if they had various strategies going on, or they had some complex looping going on where they were earning a nice APR, at least they can protect themselves there. In the event of a depeg, look, the same thing happens. The risk depositor deposits ETH, they get the ERC1155 token. But at the end of the epoch, because MIM has actually lost its peg, well, the risk depositor actually has to, that deposit of ETH actually goes. And so this goes to the hedge depositors. At the end of the epoch, they receive the risk deposits. So these deposits on this side, the hedge depositors will get them minus the fees. And 30% of the fees are going to the Y2K token holders, or the ones who voted locked. So the people who lock their tokens, the governance token, they're going to get 30% of the fees there as well. So how are these strike prices determined? Well, the Y2K team have used some standard deviations, and they've looked at the kind of the daily deviations and the frequencies that these happen, and because of that, they've got some complex mathematical equations that probably go over my head. It's been a long time since I studied maths, and you can have a read at this. You can have a read of this on their documents. I'll leave a link in the description. But essentially, they've got some formulas to basically figure out what the strike price should be. I definitely recommend giving it a read. Similarly, with the hedge pricing, they do have some mathematical equations here in which they consider kind of what the pricing should be for strike prices and hedge prices as well. So yeah, that's pretty much it. At the moment, they have a token, but it's part of the IFO. So there isn't really any liquid staking or trading, sorry, of the token, and they are considering this voted locked Y2K token. So essentially, I would assume you're going to lock this token up for a significant period of time, but as a result, you are going to get some of the fees that the protocol creates. Now you'll see here that they do have this thing called Wildfire, which is their second product, but this is coming soon, and we'll talk about this on another video. But essentially, it's a secondary market that builds on top of Earthquake, and essentially users will be able to trade via a secondary market their positions that they have, because as I'm sure you're aware, during the week your funds are locked. You can't exit midway through. You got to basically stay till the end. They do have lots of other interesting things coming up. We've got ETH derivatives. I'd like to see Frax ETH come on there as well. We've got wrapped Bitcoin. You've got kind of other exotic stable coins. We've got a lot of stable coins coming around now, and they've got some options hedgings as well. So lots of interesting things. They've got a product called Tsunami, which I'm looking forward to read about as well. So that's pretty much Earthquake. That's pretty much Y2K. Definitely give them a follow on Twitter and have a read of some of their Medium articles as well. Again, I'll leave a link in the description to them. And let's go to the platform. I think that's what you've all been waiting for. And they've got this lovely retro look to their website, which I'm a big fan of. Definitely gives inspiration from, the likes of Curve and others. So yeah, I love this kind of user interface. But yeah, essentially you're going to mint your ERC1155 token on the risk or the hedge. Which side are you? Do you think your stablecoin is going to depeg, or do you want to protect yourself? Essentially what you're going to do, and I can't do this at the moment, and that's because the epoch, the 2-day deposit period for the epoch is over. I got to wait a couple of days, and when it's open, what I'll do is I'll record another video and kind of show you exactly how it works. So there's no asset with an active deposit period at the moment. So essentially, you're going to see your 5 stable coins here, and you'll be able to select the strike price. There'll be one for the weekly and one for the monthly. So you can select the weekly or the monthly option, and then all you need to do is deposit your Ethereum. If you're going to risk, you put in 0.51 Ethereum, however much you want to kind of put in. Everyone's different, of course. At the moment, the only options for this collateral are Ethereum. Maybe in the future this does change. I would like to see maybe some stable coin of some sort, because at the end of the day, you're kind of hoping that your Ether value is going to go up. We're in a bear market, and so you're not really going to be making much money if Ethereum kind of drops in price, if you know what I mean. So essentially, yeah, you will deposit, and you just pretty much wait for your 2-day period to go, and then you've got your 5 days for the rest of the epoch, or for the monthly if that's the one you've chosen. And at the end of the epoch, you will be able to claim the reward, or you lose the reward depending on what happens to that particular stablecoin. Similarly, on the hedge side, you can do a very similar amount. Now, the amount of ether that you deposit that will basically give you a payout for the protection that you need will vary, and it depends on the formula as you have a look on the documentation. They do have some farming going on at the moment. Now, obviously, there's none that I can participate at the moment, and in order to kind of participate, you have to mint a hedge or risk position, and when you do so, you can basically stake that ERC1155 token, and you'll be able to claim some of the Y2K rewards that you can get. They're obviously giving out them at the moment with the farming rewards. So yeah, Y2K token is being distributed out at the moment, and at the end of the epoch, you'll be able to claim your reward. So yeah, you can see that I don't have a position open on this wallet at the moment, so I'll be able to mint, and it'll take me back to this page. So that's pretty much it at the moment. It's a very, very, very interesting protocol. I am a big fan of what I can see just from at the moment. Oh look, let's talk about the farms that they've got going on at the moment. I mean, look at the APRs that you're really gaining at the moment. These are incredible. So yeah, some nice Y2K token rewards coming on at the moment. So yeah, look, these are basically the vaults that you've got. So for each token, let's talk about Tether to begin with. You've got the hedge and the risk, and you can see here that they last for 5 days, because you've got the 2-day initial deposit period, and then you've got the 5 days. And then you can see here that in the risk category, or in the risk farm, the risk vault, I should say, there's about $500,000 worth of ETH. And on the hedge side, there's only about $10,000. So as you can imagine, more people are likely to think that Tether is going to maintain its peg during this period. And so what will happen on the 12th of December? Well, if Tether keeps its peg, well, all of these premiums will go to the risk vault. And if Tether does lose its peg, well, these hedge depositors are going to earn a lot of money because this $500,000 worth of assets are going to be given to these guys over here. Now, interestingly, they are earning a very, very juicy APR. So it might even be that even if there isn't a depegging event, they might still be able to make a profit overall. And you can see that it's similar for DAI, it's similar for USDC. You've got almost $1 million worth on the risk side, and again around $10,000 on the hedge side. Magic Internet Money, and of course Frax as well. So you can see that all of these assets are here. And yeah, you can see that really that a lot of people are more on the risk side than on the hedge side, and that obviously makes sense because the likelihood for a depegging event is small, but of course it still does happen, and that's why we've got let's have a look. We've got about $10,000 here, about $8,500 here. We've got $10,000 here, $7,500 here, and $9,000 here. We've basically got about $40,000 worth of assets, $45,000, something around that on the hedge side. And on the risk side, we've got maybe a few million. And at the end of the week, someone's going to win. Is it going to be the risk? Is it going to be the hedge? Someone is going to win. And that means there is always profit to be made. Even in a bear market, in a bull market, a bear market, any market, this is PvP. There is profit to be made. So Y2K is a fantastic protocol for that. I'm really interested to use it. I think it's fantastic. And I'm so excited to see what other products they bring out in the future. So this is a really innovative protocol. I'm a big fan of it. Perhaps it would have been pretty good if they got it out before the collapse of Terra. I'm sure they were working on it at the time, but just weren't able to really get it out in its proper form. So yeah, let's see what happens. Of course, I will be back with another video in the near future. Make sure you smash the like button, subscribe to the channel. If you like this sort of content, drop a comment down below, and I will be back with another video, probably covering how to basically mint one of your positions in the risk or the hedge side. So I'll be back with another video soon.